Have you ever wondered what really happens after you deposit money into a bank? Most people imagine their cash sitting safely inside a vault, untouched, waiting patiently until they come back to withdraw it. But the truth is far more shocking. Banks don't actually keep most of your money. In fact, the moment you deposit your paycheck, savings, or business income into a bank account, that money immediately starts moving through an invisible financial machine. Your money gets loaned out, invested, leveraged, multiplied, sometimes even risked. And the craziest part? The bank may only keep a tiny fraction of your deposit available at any given moment. So if the bank isn't storing your money, where does it actually go? How do banks create loans from deposits? Why do banks panic during financial crises? And what would happen if everyone tried to withdraw their money at the same time? Today, we're going deep inside the hidden system that powers the modern banking world. By the end of this video, you'll never look at your bank account the same way again. Let's begin. Section 1. The biggest lie about banking. From childhood, most people are taught a simple idea. You put money in the bank. The bank keeps it safe. Then you take it out later. Simple. But modern banking doesn't work like a storage locker. When you deposit money into a bank, legally, that money usually becomes the bank's liability, and the bank gains control over how it's used. That means your deposit is no longer sitting in a box with your name on it. Instead, the bank records your balance digitally, while the actual money flows into the banking system. Banks are businesses, and businesses exist to make profits. If banks simply stored everyone's money without using it, they would barely make any income. So instead, banks use deposits to generate even more money. This system is called fractional reserve banking, and it's one of the most important financial systems in the entire world. Here's how it works. Imagine you deposit $1,000 into a bank. The bank doesn't lock that $1,000 away forever. Instead, it may keep only a small percentage in reserve, maybe 10%, sometimes less. The rest gets loaned out to borrowers. Someone takes a loan for a car, a house, a business, a credit card purchase, and now that same money is circulating through the economy. But it gets even crazier, because when that borrower spends the money, the receiver often deposits it into another bank. Then that bank also lends most of it out again, meaning the original $1,000 can create thousands of dollars of economic activity. This is how banks help expand economies. But it also means banks rely heavily on confidence. Because if too many people demand their money back at once, the bank may not actually have enough cash available immediately. That's why trust is the foundation of banking. The system works because most people don't withdraw all their money at the same time. And once you understand this, you begin to realize something important. Your bank account balance is partly built on confidence, not physical cash. Section 2. Where your money actually goes. So where does deposited money really go? The answer is everywhere. Banks move money through multiple channels simultaneously. The first major destination is loans. Loans are the lifeblood of banking profits. When banks lend money, they charge interest. That interest becomes revenue. For example, a bank may pay you 1% interest on your savings account, but then lend your deposited money to someone else at 10% interest. The difference becomes profit. This is called the interest spread, and it's one of the oldest banking business models in history. Your deposits help fund mortgages, car loans, business expansions, student loans, credit cards, personal loans, even government financing. Every day, trillions of dollars move through this global lending system. But banks don't stop there. Many banks also invest money into financial assets, government bonds, treasury securities, corporate debt, foreign exchange markets, and sometimes even stock-related financial products. Large commercial banks often operate massive investment divisions. Some banks participate in international markets worth trillions of dollars daily. Your deposited money becomes part of a giant financial ecosystem constantly moving around the globe. And here's something many people don't realize. Most money today isn't physical cash at all. It's digital numbers stored inside banking databases. When banks approve loans, they often create new digital money through accounting entries. That means modern banks don't simply transfer existing money. They also help create new money within the economy. This is one reason banking systems are so powerful. They influence spending, economic growth, inflation, housing markets, business activity, and even national stability. Banks aren't just money holders. They are money creators. Section 3. the magic of money creation. This next part sounds unbelievable at first, but it's how modern finance works. When banks issue loans, they effectively create new money. Let's simplify this. Suppose a bank has $1 million in deposits. Under reserve requirements, it may lend out a large portion of that money. A borrower receives a loan for $200,000 to buy a house. Now here's the key point. The borrower suddenly has access to new, spendable money. The seller receives the payment and deposits it into another bank. That second bank can also lend a portion of it out again. This cycle repeats throughout the economy. As a result, banking systems expand the total money supply far beyond the amount of physical cash that exists. This process helps economies grow. Businesses can borrow to expand. Families can buy homes. Entrepreneurs can launch companies. Consumers can spend. Without banking credit systems, modern economies would grow far more slowly. But there's a downside. Too much lending can create bubbles. Housing bubbles, debt bubbles, stock market bubbles, and eventually, financial crashes. Because when credit expands too aggressively, people borrow more than they can realistically repay. Banks make profits during expansion. But during downturns, bad loans become dangerous. This is why banking crises happen repeatedly throughout history. The same system that creates growth can also create instability. Section 4. Why banks want your deposits so badly. Have you noticed banks constantly encouraging people to open accounts? Savings accounts, checking accounts, fixed deposits, online banking, mobile banking, business accounts. Why? Because deposits are fuel for banking operations. The more deposits a bank controls, the more financial power it has. Deposits allow banks to expand lending activities, and lending generates profits. This is why banks compete aggressively for customers. Sometimes they offer bonuses just for opening accounts, or high introductory interest rates, or rewards programs. Your money is valuable to banks because it helps them operate the entire lending system. In many ways, deposits are the raw material banks use to manufacture profits. And the larger the bank becomes, the more influence it gains within the financial system. Some banks become so large that governments consider them too big to fail, meaning if they collapse, the damage could spread across the entire economy. That's exactly what happened during the global financial crisis of 2008, and it revealed just how interconnected the banking world truly is. Section 5. What happened during the 2008 financial crisis? In 2008, millions of people learned a terrifying lesson. Banks are not invincible. Before the crisis, banks issued enormous numbers of risky mortgages. Many loans went to people who couldn't realistically afford them. Why? Because banks were making huge profits. Housing prices kept rising. Lenders believed the system would continue forever. But eventually, reality hit. Borrowers started defaulting. Mortgage-backed investments collapsed. Financial institutions began losing billions. Trust disappeared. And when trust disappears in banking, panic begins. People feared banks might fail. Investors rushed to pull money out. Markets crashed. Major institutions collapsed. Governments stepped in with emergency bailouts. The crisis spread worldwide. Millions lost jobs, homes, businesses, retirement savings. Entire economies slowed down. And all of it revealed a crucial truth. Modern banking systems operate on confidence. Once fear spreads, even giant financial institutions can become vulnerable. That's why governments and central banks work so hard to stabilize banking systems during crises. Because if trust collapses completely, the entire economy can freeze. Section 6. What is a bank run? Now imagine this scenario. You hear rumors your bank might be in trouble. You rush to withdraw your money. Thousands of other people do the same thing. Suddenly, the bank faces massive withdrawal demands. But remember, banks don't keep all deposits available in cash form. Much of the money has already been loaned out or invested. This situation is called a bank run. And historically, bank runs have destroyed financial institutions. Even healthy banks can collapse if too many people panic simultaneously. Because banking depends heavily on timing. Loans may take years to repay. But depositors can demand money instantly. That mismatch creates vulnerability. This is why governments introduced deposit insurance systems in many countries. Deposit insurance helps reassure the public that their money is protected up to certain limits. The goal is simple: prevent panic. Because once fear spreads through banking systems, the damage can escalate rapidly. Section 7. Central banks. The real power behind the system. Behind ordinary banks stands another powerful institution, the central bank. Examples include the Federal Reserve, the European Central Bank, and the Central Bank of Nigeria. Central banks play a massive role in stabilizing financial systems. They influence interest rates, control money supply, regulate liquidity, and act as lenders of last resort during emergencies. When commercial banks face cash shortages, central banks can inject liquidity into the system. This helps prevent widespread collapse. Central banks also influence inflation. When they lower interest rates, borrowing becomes cheaper. People spend more. Businesses invest more. Economic activity increases. But too much money creation can fuel inflation. So central banks constantly balance growth against stability. Their decisions affect mortgages, business loans, investments, savings, and even unemployment. Most people rarely think about central banks, but they quietly shape the entire financial world. Section 8. Why your money feels invisible. In the past, people handled physical cash more often. Today, most money exists digitally. Salaries arrive electronically. Payments happen through apps. Transfers occur instantly. Credit cards dominate spending. Many people rarely touch cash anymore. This creates an illusion. You see numbers on a screen and assume money physically exists somewhere waiting for you. But modern banking is mostly electronic accounting. Banks track balances digitally while money flows continuously between institutions. This digital system increases efficiency enormously, but it also increases complexity. Trillions of dollars move globally every day through invisible financial networks. And because so much money exists digitally, central banks and commercial banks wield enormous influence over economic activity. In many ways, modern economies run on digital trust systems, not stacks of paper currency. Section 9. Do banks actually need your money to lend? This question confuses many people. If banks can create loans digitally, do they really need deposits? The answer is yes, but not in the way most people think. Deposits still matter because banks must maintain liquidity, reserves, and regulatory requirements. Banks also need customer confidence. A bank with strong deposits appears stable, and stable banks attract investors and borrowers. Deposits remain one of the cheapest funding sources available to banks. So while modern lending systems are more complex than simple cash storage, deposits are still extremely important. Your money helps support the banking structure, even if it's not literally sitting untouched in a vault. Section 10. How banks make billions. Banks earn money from multiple streams. Interest on loans, credit card fees, overdraft fees, investment services, wire transfer charges, business banking, trading operations, asset management, foreign exchange transactions, and much more. Large global banks operate like financial empires. Some handle trillions in assets. They influence governments, corporations, markets, and international trade. Banking has become one of the most powerful industries in the world. And because money touches every part of society, banking influence extends everywhere. Real estate, technology, healthcare, education, politics, infrastructure, consumer spending. Virtually every major economic sector depends on banking systems functioning properly. That's why financial crises become national emergencies. Section 15. The future of banking. Banking is evolving rapidly. Digital banking, mobile payments, online-only banks, artificial intelligence, cryptocurrency, central bank digital currencies, fintech companies. The future may look very different from traditional banking systems, but one thing will likely remain the same. Money will continue flowing through networks of trust. Whether physical or digital, economies require systems people believe in, and banks will continue playing a central role in moving capital through society. The methods may change. The technology may evolve, but the core principle remains. Banking is about confidence, lending, and economic circulation, not simply storing cash. Final thoughts. So, where does your money actually go after you deposit it into a bank? It goes into loans, investments, financial markets, economic activity, digital systems, and global financial networks. Banks don't simply hold money. They move it, multiply it, lend it, and use it to power the economy itself. That's why banking is both incredibly powerful and occasionally dangerous. The entire system depends on trust. And once you understand that, you begin seeing the financial world differently. Your bank account isn't just a storage box. It's part of a massive global financial machine operating every second of every day. And now you know what really happens behind the scenes. If you enjoyed this video, make sure to subscribe to Financial Education TV for more deep financial breakdowns explained in simple terms. And remember, the more you understand money, the less controlled by it you become. Thanks for watching.